sorry, the recession is going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. It could go down, easily go down 30%, and it wouldn't shock me if it was down 50%. You're looking at, S&P, 2000, 2100, something like that. I see a much more severe recession based on a lot of factors, some of which we've spoken about. I think your use of the word global is very much on point, because it's often the case that, you look around the world, you got the United States, or, North America, if you want to throw in Canada, you've got the EU, you've got China, you've got Japan, they're all important economies, but they can kind of be in different parts of the business cycle. And it's not unusual for one part to be in recession, but another part of the world is like doing better. So then they use the phrase locomotive theory. The locomotive is going to pull us all out of the ditch, and we'll get going. So it's not unusual to have recessions in the United States or Europe, or particular countries in Europe or Japan. I mean, Japan's had 9 recessions since 1989. I mean, 9. I consider that one long 30-year depression. That's a debate for another day, but that's how I would describe Japan. But it usually, one's not doing so well and another part of the world's doing better. That's not the case. What is happening right now, I see it, but there's an awful lot of data to back it up, is that we are going into, or may already be in, a global recession. Now that's rare. It's rare when, hey, China, Japan, US, Germany, they're all in recession at the same time. But that's what's unfolding. That's a big deal. Well, for obvious reasons, because it affects basically everyone. But there's no life preserver. There's no, it's not like China's going to pull us all out of it with cheap exports, or Japan's going to, put the pedal to the metal in terms of, fixed asset investment, et cetera. So that's a really bad sign. I mean, and just to be very specific, we just saw U.S. fourth quarter GDP grew at a 2.9% annualized rate. People are like, yeah, it's pretty good. And, it's not good by post-1980 standards. It's not good at all by post-World War II standards, but post-2008, yeah, that's not bad. But again, you have to disaggregate it, and you look at what grew. It was inventories were a big contributor, and net exports were a big contributor. Consumer durables, but fixed asset investment in particular. There was a big load of aircraft orders for Boeing, which is notoriously lumpy. They'll have a big month, blowout month, and then nothing for a couple of months, not nothing, but something very low. So when you look at that, inventories are counted as part of GDP, of course, but it's not necessarily a good thing. If inventories are piling up, it means retailers are not buying. The stuff's arriving, and this kind of goes back to the whole supply chain breakdown of a year ago. That's what my book Sold Out was about. So you go back to, let's say, the spring of 2022. The supply chain had completely fallen apart. And if you were a purchasing manager and you were saying to yourself, okay, we're kind of coming out of COVID, we're going to start growing, but the supply chain is broken. So instead of ordering one, container, I'm going to order 3 containers, because maybe one will get through, through the bottlenecks. I only want one, but I'm going to order 3 and hope for the best. What happened was a lot of the stuff was alleviated, not for good reasons, not really for logistical reasons, but because the consumer slowed down a lot beginning in June, partly in reaction to the Fed starting to hike rates in March of 2022. And then here come the 3 containers. So at the exact moment when demand destruction is kicking in, your inventory is going to the rafters. So what do retailers do, or wholesalers for that matter, but retail, they slash prices, that 2-for-1 sales, because inventories are a nightmare for retailers for obvious reasons. Number one, you have to finance them, so they eat up working capital. It could be cash, but now you got a bunch of stuff in the back office. And number two, it just takes up space. I mean, insurance costs and other costs like that. But the other thing people kind of underestimate is that, like, fashion stuff goes out of fashion. Last spring's styles are not next spring styles. You usually got last spring stuff. Good luck. We're getting close to spring, so you're dumping that stuff. Consumer electronics, you got an iPhone 13. Well, everybody wants an iPhone 14, whatever. I mean, you take the point. So piling up inventories is a very unhealthy sign. It means the retail sector is drying up, demand destruction is kicking in, costs are going up because you got to finance all this stuff, and your profit margins are going down. So I don't take a lot of comfort from that. But the other thing, Adam, and this is important, quarters, 3 months, obviously. If to the extent you can disaggregate monthly data, and there's a lot of monthly data, 2.9% annualized for the quarter, but it really slowed down in December. So it was sort of a waning type of thing. Christmas was a disaster. I mean, people bought stuff for Christmas, but way below expectations. And again, it goes back to piling up the inventory at the worst possible time. So it looks like the US is going into 2023. Possibly recession started in December. If not, we start soon. But you're seeing the same thing in Europe now. Europe got a break with the weather. Obviously there's a war going on, so that's a big factor. But and natural gas prices skyrocketed, and oil prices skyrocketed again in mid 2022. They've come down, and people expected them, and I don't include myself, to go up again because of the winter. But the winter turned out to be pretty mild. I saw pictures of people like kayaking around Copenhagen, it was like in t-shirts, so that was the break. That's act of God, but it works. So they got a little bit of a break, but it doesn't mean that all is well or they're out of the woods. And there are other things going on. China is a basket case. They're zero, they went from zero COVID, which was, it was bad public policy and bad health policy, but they did it anyway, maybe for political reasons, because Xi was trying to get through the National Party Congress in October 2022. But he did, and he's emperor for life, the new Emperor Xi. So they flipped almost on a dime. Now, there were riots beginning November 24th, 2022, pretty bad ones. People raged through cities. They tore down all these testing tents. They knocked down barricades. They hung banners. And the leadership in Beijing, they're looking at this thinking Tiananmen Square, 1989. So they just turned on a dime and said, okay, let it rip. The policy, let it rip. Okay, let everyone get infected, and we'll do the best we can. And but one of the ways you get through it is by letting it rip, and you develop what's called herd immunity. And that's what worked in North America and Europe. So China decided to let it rip. But when you look at the numbers, you're like, okay, you have 1.4 billion people. So you take a modest infection rate, meaning, like 30%, let's say, you're talking, round number, 450 million infections. And if you assume a modest mortality rate at 1/4 of 1%, and that's borne out by the data, you're looking at close to 2 million dead. Now, those are on conservative assumptions. If you dial up the infection rate to closer to 50%, and the mortality rate to 1/2 of 1%, now you're looking at 5 million dead. Again, round numbers. But the other difference between China and Europe and the US is that they don't have the healthcare system to deal with it. Our healthcare system, which is pretty good, was strained. Same thing in Europe. China has nowhere near the ICU units, the oxygen, the treatments, the professionals, the nurses and doctors, not even close. And when you get out to the village level, which is where most of the people still live, believe it or not, they often have nothing. And it actually is an interesting supply chain twist there, because the Chinese were more or less told, you have to self-medicate. We don't have the hospital beds for you. So they went out and stripped the shelves of ibuprofen, Tamiflu, Motrin, cough medicine, whatever they could get. The Beijing actually said, go back to TCM. Like, what's TCM? It's like traditional Chinese medicine, herbs and teas and things like that. Well, I'm not knocking it, by the way. Some of that stuff's pretty healthy, but they're at a primitive level. They're like kind of at the Bronze Age level. But that is hurting the economy as much as the zero COVID. They had no good ways out. I'm not saying one's better than the other. They're both awful, but you still have a lot of things that are not COVID. The real estate collapse, the excessive debt, the demographic decline, just the impact of top-down management when you can't possibly get everything right, and decoupling from the U.S. and the U.S. cutting off, high-tech exports to China, including third country exports where they're relying on U.S. licenses or equipment. So China's in a deep hole, probably in a recession. Japan, same thing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, yeah, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession based on a lot of factors, some of which we've spoken about.